Hey, business owner, are you curious how the new Big Beautiful Bill will affect your company over the next few years? Then this podcast is for you. Listen up. Hi, everyone. Welcome to another episode of Beyond the Shears, where groomers get business savvy. I'm your host, Crystal, the groomer's accountant. Today is a special solo episode where I discuss the recently passed Big Beautiful Bill. The Big Beautiful Bill has passed and was signed into law on July 4th, 2025 by President Trump. So, what does that mean for savvy taxpayers and business owners? I'm glad you asked. Let's break down a few of the main provisions in the bill and how you can benefit. In this podcast, I will break down each provision and provide a straightforward explanation. This podcast is featured on Apple and Spotify. I have also created a video for YouTube featuring video graphics for those that are more visual in nature, like myself. And anyone looking for accounting and tax services for your business or simply considering working with me and my team, please go to www.petbizadvisors.com/consultation to book in a free 30-minute consultation to see if your business would benefit from working with us. Now, let's get into it. The first provision is the permanent decrease in individual income tax rates. So what does that mean? This one actually has the largest impact over the 10-year period, costing $2 trillion. In other words, the funds are being put back into the taxpayer pockets over the next decade. Notice when I say costing money, it is actually taking it away from government and giving it back to the taxpayers. So I'll wait here a minute for you to understand and figure out why the government would be so mad about this. I need some Jeopardy music here, right? Okay, so let's get into the breakdown of it. In 2017, the original income tax rate was at 39.6%. So it went down to 37%. And then we had a 25% tax bracket rate down to 22%, and then 15% down to 12%. So we obviously see that these tax rates are less and actually will save the taxpayers some money. The tax rate reductions were temporary in nature and expected to expire at the end of 2025. This would have caused additional tax liability on the taxpayer themselves. You, as the taxpayer, do not have to do anything on the tax return to accept these permanent rates. The tax software will automatically calculate it as the appropriate rate or at the appropriate rate. So if you file your own taxes, you're good to go. So I know a lot of my listeners sometimes will file using tax software such as TurboTax, and so you're good. So that tax software will automatically put this information in there and you are good. So the next provision, provision number 2, is the permanent increase to the standard deduction. So close to 90% of taxpayers claim at this time the standard deduction instead of the itemized deduction. So what does that mean? So in 2017, before these provisions went into place, the standard deduction was $6,350 for single taxpayers and $12,700 for married taxpayers. And now for 2025, that has increased because of the bill to $15,750 for single taxpayers, and married filing jointly is $31,500. Now, I do want to take a step back because some of you out there actually filed married single. So you would actually use the single taxpayer rate. When I say single, that also is provisions for you. So if you filed married single, you would use the single taxpayer rate, just to kind of keep that in clarity. Now, those of you that do file head of household, you have increased for 2025 to $23,625. Now, moving forward, I probably will not touch a lot on the head of household. I'm just going to be using the single taxpayer rate and the married filing jointly taxpayer rates. Okay. So these deductions were set to expire at the end of 2025. And this bill not only extends the deduction, but makes them permanent. So what does that mean? Well, it means that, once this administration leaves the office, they will continue to be in effect. So we don't have any expiration date on these new increases. Now, my curiosity is, are they going to extend those even more? So I'm kind of curious for that because obviously we know cost of living and inflation continues to go up, right? So I'm kind of curious as to where that is going to go. But at least we do have a pretty solid permanency in place. So they're not at least going to reduce and therefore increasing your tax liability. So provision number 3 is called the temporary upgrade to the itemized deduction or SALT tax, SALT, SALT tax. Now, what does SALT stand for? It's the state and local income tax, essentially. So by this bill passing, there was a lot of talk about SALT, and I'm sure a lot of you have heard about that. There was a huge discussion about this in the actual tax bill itself and the provisions. So, because originally the SALT tax was capped at $10,000 for those that itemize on their tax return. So, what does that mean? Well, let's just say that your state and local income taxes, including your property taxes, you could only take $10,000 of a provisional tax rate or tax deduction for that. And so what that means is that, people that are living, like say in the state of California or New York, really would not get even a fraction of the taxes that they paid in, even just for property taxes, because they're outrageous, right? So what happens now? Well, now we have this $40,000 increase. So it went from $10,000 cap to now a $40,000 cap, which, for a lot of higher earned income earners and property tax people, it's still not great, but obviously clearly, $30,000 increase is better than nothing. So we're happy about that one. I wouldn't personally call that a win, but it's better. So, okay. So provision number 4. We have a temporary car loan interest deduction. So up to $10,000 on qualifying cars through the end of 2028. So what does qualifying mean? Well, they have to be American-made cars. And it's on loans that you take from this point on until the end of 2028. You can qualify for a $10,000 interest deduction. And you do not have to itemize. That was been a big question for me. Well, with this interest, do I have to itemize? And the thing is, you do not. You do not have to itemize. You can take the standard deduction and still qualify for the $10,000 deduction for the loan interest. But it is subject to income limitations. And so the income limitations are a $100,000 for filing single and $200,000 if filing married jointly. And what does that mean? So if you make over this amount of money for your taxable income, then you're not qualified for that. Okay. All right. So the next provision number 5, is we see a permanent increase to the child tax credit. And so for those with kids, listen up. So we have another provision that was set to expire in 2025, and this was the $2,000 child tax credit. Without the bill being passed, the credit would have been cut in half to $1,000 effective, at the end of 2025. But now with the bill's approval, it not only extends the credit, but increases it from $2,000 to $2,200 per child. So this is expected to save taxpayers around $800 billion over the next decade. And there is a phase out with your income starting at $200,000 for single taxpayers and $400,000 for married taxpayers. So clearly the phase out is much higher than it is in all of these other provisions. So it actually does help. And also, I do want to give a shout out to this. It's going to actually save the 800 billion. But in the other ones, I failed to mention the permanent increase to the standard deduction is expected to save taxpayers over $1 trillion in the next decade. So again, a lot of these, it's going to cost money kind of things. It depends on how you look at it. So I personally, as a taxpayer and as a business owner, would like to see a lot of this money stay in my pocket instead of giving it to the government to spend on my behalf. Okay, so the next one is provision number 6, increase to senior tax deductions for individuals over the age of 65. So we've all heard about the no tax on Social Security, right? Well, unfortunately, that did not happen in the bill the way that they were hoping, but those over the age of 65 are getting a $6,000 additional deduction on their tax returns. No, this is in addition to the standard deduction previously mentioned. So you get both. Prior to the bill, seniors were only entitled to a $2,000 deduction for single filers and a $3,200 deduction if married, and both were over the age of 65. This increases to $6,000 for each qualifying individual based on the income limits of $75,000 single and $150,000 for married couples. So, for example, let's say we're 65, over the age of 65, and we are a single taxpayer. That means your total standard deduction with the new provision is $21,750, which is a sizable difference from what we're paying. So that's honestly, that's better than nothing. Definitely. I kind of wish that it would have been the entire no tax on Social Security, period, because I think people that are on Social Security, obviously they're on a very limited income and they are capped off of how much money they can make. So I think that's only fair to not have that money taxable, but this is better than nothing at this point. Okay, so another approved tax provision, we'll say tax provision number 7, is the no tax on overtime. No tax on overtime. This is a big one. And of course, I'll get to the no tax on tips here in just a second. But these two are really in the grooming world. It seems to be like the most frequently asked questions that I'm getting. Like, where do we stand with all of this? So let me break down what this actually does for you. We look at the deductions against your overtime wages. So this is a direct deduction against your overtime wages, which will result in no tax on that portion of your income. All right. So basically, there are limits, though, here. There are limits as far as how much you can deduct. It's $12,500 per single. And again, this is strictly overtime amounts. $12,500 per single, $25,000 for married filing joint. You again have income limits here. So your income for single is $150,000. And for married filing jointly, it's $300,000. So now a lot of people out there are salaried employees. This doesn't pertain to you. There are people out there that work on commission. This doesn't pertain to you. This is for hourly people that are non-exempt. And so therefore they can get overtime. So that's what this actually files for. All right. So let me know in the comments if you have any questions about that. So now let's move on to the provision number 8, no tax on tips. Now, this is subject to $25,000 limit for the deduction and income limits of $150,000 and $300,000 if you're filing jointly, just like the no tax on overtime limitations. So now, one of the biggest questions I get is that who actually qualifies and what qualifies for this? So number 1, you must be in an occupation where individuals regularly and customarily receive tip income. It applies to employees and certain business owners that provide hospitality services, personal care services, transportation, and certain creative and retail services. Now, those of us in specialized trades, such as doctors, lawyers, accountants, dentists, or any business where the reputation and skill are the main reason people come to see you, then we do not qualify. Sorry, other accountants out there. I know I was bummed too. I was going to start just saying everything was tips. My clients love me so much, they give me all kinds of tips. But unfortunately, that's not the case with us. So, for my pet groomers out there, you absolutely do qualify. I do know that in the beginning, when all of this first started coming out, this was the biggest question because people said, well, it says personalized service or personal services. Is that dog grooming? Well, I looked up the NAICS code. I know, so much fun. But that's the code that typically is written on your tax return as far as for what type of business you have. And the code 8129, which is where pet groomers and pet boarding people and trainers, dog walkers, all of this, they all start with 8129. That is considered other personal services. So yes, you do qualify for this. And I would say that it would be considered personal services. So therefore, you would be tax exempt up to the first $25,000 in tips. Now, the next question I get to is like, okay, great. No tax on tips for $25,000. I'll take it. Now, how will this show up on my tax return? And the true answer is we're not really sure right now. Now, in the past, our tax software will oftentimes allow us to key in a dollar amount on the return, showing how much of the amount of money or the amount of income we can take off that would be non-taxable. I'm hoping it will be something similar to that, but I don't know if they're going to do something with your quarterly payroll tax returns, and then therefore it would affect your W-2. So we're going to have to wait and see. Honestly, and we all know this, with the federal government, they tend to make it almost as complicated as possible. So I wouldn't be surprised if it's affecting the quarterly returns and we're going to have to show it on the W-2 somehow. I hope that's not the case. I'm hoping we can just do a quick entry into the tax software for the year and we're going to be good to go. So fingers crossed for that. Okay, so the next one is provision number 9, the permanent QBI extension. So this is the qualified business income deduction. Now this mostly obviously is just for business owners. So business owners, please listen up. I don't even know if some of the business owners that I've talked to in the past, I don't think they even knew this was a thing. And it's been in existence since 2017. And so this qualified business income deduction basically will help save business owners billions, as a B, billions over the next decade. This was the one I was most vocal about as both a business owner and then also helping so many small businesses out there. I knew how much of an issue that it not passing this deduction would be for cash flow for all of these small businesses. So what is the QBI deduction? It's an immediate 20% of qualifying business income. And it's basically a deduction that takes 20% off of your income, essentially. So let's say, for example, we have a business that has $100,000 in net business income. All right. That's after all of your expenses. And so that means there's other provisions in there, but let's just keep it simple. So $100,000, 20%, you would get a $20,000 tax deduction immediately. And that's sizable, right? That's pretty sweet. And so I didn't want that to go away anytime soon. Now, there are only select businesses that qualify for this, and those are sole proprietors, LLCs, and S Corps. So sorry, C Corps out there, you don't qualify for this one. But there are ways you can structure your businesses. You can actually, segregate your businesses out. And then that way, part of your business would actually qualify for this. It's more complex to do that. It's actually splitting your businesses. And obviously, you would need an accountant's help to do that. So we can help you with that if you're interested. So if you do have a C Corp, we might actually be able to break out some of your business or products and be able to qualify you for some of these deductions. So And it does actually start to phase out with higher income businesses. I will have to look and see how much that provision is with this new, if they made any changes to that, and I can put that in the comments below. I will do that, or I'll put it in the captions on the video, so that way you can see. Okay, approved tax provision number 10, the permanent extension of bonus depreciation. Now, those of you that have worked with me or talked to me even remotely know that depreciation is actually one of my favorite tax tools of all time. And why is that? Well, it's so versatile in how you can use it, because do you need to take all this deduction up front, or can you actually, space it out as far as how you take this deduction? So let's say if you were a newer business, you don't and probably wouldn't need all of your depreciation on these larger pieces of equipment or furnitures and fixtures, leasehold improvements that you have all in year one, because typically year one, you're not making as much money as you would be in years 2, 3, or 4, right? So I like to be able to use depreciation as a tool. So let's take less in year one and then be able to save some for subsequent years to be able to lower that taxable income for the taxpayer. So what does bonus depreciation do? It grants additional tax deductions against tangible or investments property, such as vehicles, machinery, equipment, furnitures, and fixtures. And obviously that includes leasehold improvements. I know a lot of you out there rent a space or lease a space, and you do make improvements to that area. So originally it was 40% is how much the bonus depreciation has been recently. And then that increases it to 100% of purchases after January 19th, 2025. And it took me a second to realize, I'm like, why is it such an odd date? I'm like, oh, that's because Trump was sworn in on January 20th. Okay, never mind. I'm catching up now. So what does that mean? It means you can't take actually a full 100% of depreciation if you need it. You don't have to. You absolutely do not have to. But it's nice for people that might have an increase of income for the year, and they need to offset that income. So it gives you the flexibility that you need in order to do that. So yeah, and I love depreciation as a tax tool mostly because it simultaneously lowers your taxable income. But let's say you have to go get a loan with the banks will add back in depreciation for qualification purposes. So let's say that you made $100,000 in net income for the year, but let's say 20,000 of that was depreciation you took on leasehold improvements and equipment. Well, guess what? The bank will add that back in. So you actually now can qualify with $120,000 instead of 100, but you only pay taxes on 100,000. Kind of neat thing, right? So, but keep in mind, obviously depreciation, it's can be a double-edged sword. So when you sell an item, let's say you have a car and you sold a car, you will have to add back in any depreciation you've already taken on that vehicle. So let's say you bought a car for $20,000 for your business. You've already taken $7,500 in depreciation, and you sold it for $15,000. So what the common person would think was, well, I had a $5,000 loss because I paid $20,000, sold it for for 15, and then so I lost 5 on it. Well, the thing is, that's not right. We've also taken 7,500 in depreciation over time. And so therefore we would have a net capital gain of 2,500. So the formula actually is $20,000 minus the 7,500 in depreciation we've taken, which means that the cost basis is now 12,500. We sold it for 15,000, which is where now we have a capital gain of 2,500. So I know it's so much fun, but that's also why it's kind of important to make sure you have a reputable accountant or someone you can talk to about this. Okay. All right, let's get the approved tax provision number 11, which is the higher 1099 threshold. So what does this mean? Well, originally, for those business owners that do file for the 1099s, and hopefully most of you do, because most of you would have a filing requirement, there was a $600 limit for any contractor that you pay over $600 a year for cumulative. It doesn't have to be one payment. It's just for the entire year, right? Of course, these are subject to what you're paying them for, whether or not it's products or services, and what that actual contractor is doing for you. Of course, we'll get into the specifics of the 1099 filing requirements here, but it was $600. Now that limit has been raised to $2,000. So it actually will help out small business owners because they don't have to pay, or I should say send out as many 1099s each year, since it has moved up from 600 to 2,000. Obviously, taking into consideration inflation and cost of living increases, because it's been $600. Oh my gosh, since I can remember. I mean, for decades, it's been $600, and that has not gone up. So was, as a tax provider, tax preparer and things, I was very happy to see that. So hopefully that will cut back on some of the costs in filing requirements for compliance on that. The next one is approved tax provision number 12, and that's for charitable contributions. Obviously, this is for individual taxpayers, but this is where previously only people that itemize on their tax return could actually take the charitable contribution. And so what this does is it allows people, even if you are a standard deduction person, which, like I said previously, almost 90% of people are standard deduction people, then you can claim up to $1,000 on if you file single and $2,000 if you file married filing jointly, even if you don't itemize. So this is a really good deal. So you can count your donations to churches and other 501c organizations, and that way you can actually have that deduction benefit as well. Now, what do I believe about all of this? Like, what is my personal opinion about all of this? Is it's mostly good, as far as, especially when it comes to small business owners, it's mostly good. But there are some provisions in here that are a little uncertain, because a lot of these only go into effect as of 2026, and they only last to 2028. And so they're only there for just a few years. For example, the no tax on tips is only good for 26, 27, and 28. So that will significantly reduce your tax liability, but it's only temporary. And so a lot of these, for the normal everyday taxpayer and small business owner, it's only going to go into effect just for a few years, and then it's going to go away unless, Congress passes something more permanent. But right now, I mean, I was surprised we got what we got from this one. So I was very grateful, but I was really surprised. So we'll see how that goes. All right, cats and kittens, I think I want to end things there in terms of all the fun tax talk for this episode. If you have any questions, please post in the comments below. I'll be happy to work with you, and let's open a discussion. What are your favorite provisions of the Big Beautiful Bill, and what are some things you do not like? Even those I didn't discuss in this episode, feel free to leave them down in the comments. Thank you all for listening and watching on YouTube. If you have not already, please like and subscribe and share this video with other business owners you know would benefit. And see you next time. Bye.